SpaceMob podcast.
We just basically turn your phone and be seamless. Regardless of where you are, we don't want the user even to know that it's connected by satellite. Listen, the opportunity that we have is very, very, very large.
Hey everyone, thanks for joining. Figured I'd just fire up a midday space and just talk about some of the volatility today, which is not unexpected. I think there's been it's been consensus among institutions that perhaps we'd experience some type of pullback in February, and here we are. We're getting pullback. And I think it's important to put everything in context where the sectors that you and I invest in are up quite a lot this year, and they were up a lot last year. And so it's natural to have some of these pullbacks. I had talked about this idea of knowing what you own being important, because I think when you look at these periods of volatility, which, I mentioned for institutions, especially for hedge funds that are, and in particular pod shops, where you've got teams of portfolio managers and analysts that are managing some capital and have really tight risk limits, and they've got to manage, factor risks as well. Days like this are bad for them, right? And so you're going to have, because they're running leverage, you're going to have exaggerated moves where people have to de-risk and things start moving down. It also doesn't help that you have Bitcoin, which I haven't been invested in a long time. The last time I ever owned Bitcoin, I think I sold at 64,000. My average was like, true story, I think my average was like 5,000, and I held the entire way and sold what was at that point a near-term top. But yeah, crypto selling off with Bitcoin at 73,000, which is lower than when Trump entered, the presidency. That's not good for risk assets, because at the end of the day, like, all this stuff is to varying degrees correlated. And so there's going to be investors out there, if you can imagine, who have some space exposure and maybe some crypto exposure. And if they're getting hit on one thing, then they might be more apt to sell the thing that they're up in. And so that's what typically happens when you have sell-offs, where correlations, meaning co-movement, goes to one, where everything kind of moves together, because you have people who are selling one thing to stay alive or to cover margin. And that's why you'll see assets across the board sell down. And so, for example, T1 Energy, which I'm involved in, that's off quite a bit. And, ASD SpaceMob is off quite a bit. Those are two big winners. But if you look across, whether it's space industry or some of the other high beta names, like next generation nuclear names, they're all down pretty much the same levels. I mean, for T1 Energy, that one's down 17.5%. And another favorite, which is focused on batteries, is EOS, and that's down 17.5%. So not anything out of the ordinary. I think as people on Twitter always look for something to explain the move, sometimes you just have a healthy pullback. And so, of course, there is some concern about the potential for a conflict on Iran, and those headlines didn't help earlier today. But I think what sparked the recent pullback has been Anthropic's like new software tools, and concerns that people have around software names in general, that AI perhaps is going to disrupt that entire industry. And so I was just looking at the software ETF, and that thing has been an absolute disaster. I think it's almost at a point now, it's almost about to reach the levels back in April 2025 when we had those tariff scares. But yeah, like I said before, as you get de-risking in a heavy way in one particular area of the growth in the markets, then it can kind of trickle into other areas as well. So today is not out of the ordinary, and I think, as I said before, it's important to know what you own, because oftentimes, and I'm guilty of this too, like if someone like presents you an interesting idea and you take a look at it, or sometimes you don't, you might just, it sounds good enough and you just buy a small position. Then whenever volatility hits, that position is usually the first one that you sell, because you don't really know much about it, and it's not something that you have conviction in. And maybe it was just a trade, But then at the first side of volatility, you might hold on to it, but then if things go down even further and your portfolio is taking a pretty big hit, then you might. And so there's quite a few people. When you look out on Twitter, there's like these traders, and they'll be in a position, they're down 10, 20% on a particular name, and they're like, oh, this is bad. Something, the company needs to do something, and they blame everyone but themselves, and then they sell and they lose money. And that's the big difference for folks who actually understand what they hold. And so if you have a drawdown of 10, 15, 20%, you are more likely to hold that position. And if anything, if you liked it at, a price of, let's say 130, you're going to love it at 100. And so when you actually understand what you own, that might give you the conviction to add at those times during a drawdown, or at least hold. And so, I was joking with someone, there's like a few people on the ASTS hashtag where they talk about, that they're down and this is bad and they're selling out. And that's what we call like negative gamma, when if you don't know something, you end up buying it high and then you end up selling it low. And so you don't do yourself any favors by losing money on those types of trades where you don't really understand what's going on. So, and then I got this other guy, let's see, Tim Stobersky. The news about AT&T choosing Amazon Leo for fixed satellite internet is contributing to this. No, that's not, Tim. I hate to break it to you, but the entire sector. Let's take a look. For those that don't know, AT&T announced a partnership with Amazon Leo. They are going to use Amazon fixed wireless to then connect enterprise customers that are far away from fiber coverage or wireless coverage. And so it's a very different, market. And obviously Amazon Leo is complementary to what AST SpaceMob is doing. Imagine Starlink fixed wireless to home and then Starlink direct to cell. Those are two different things. Amazon Leo is competing with Starlink direct to home, fixed wireless. And so that news today, some people were trying to point fingers like, oh, that's what's causing the stock price to be down. I don't think so. I mean, I guess perhaps at the margin for some people who don't really understand the company, who own it, but they don't understand it. I guess, some people may have sold, but if you look at the space sector, I mean, Rocket Lab's down 14%, Redwire's down 13%, Planet Labs 13%, Intuitive Machines 17%, Karman 15%. Even like some of these popular defense names like Kratos, which does some space stuff too, is down 15%. So again, like people are going to try to find reasons why a stock price is down, but it's the market is down. All the growth names. I mean, you look at some of these quantum names. IonQ is down 11.5%. Rigetti's down 10%, and so it's not, it's not just space companies. I mean, so what was interesting is Jim Chanos, who's been pretty negative on data centers because he thinks it's a bubble. He threw a bomb today, or maybe it was yesterday, but he tweeted that, oh, if these data centers in space become a reality, then there's no terminal value for data centers on Earth, which makes zero sense to me. It could crimp some of the potential growth, but we're far from that. Like as I mentioned before yesterday, the cost per kilogram has to come down quite significantly for space data centers to be competitive with data centers here on Earth. But that said, all those names are down huge. Like Cypher is down 19%, Iron's down 17%, Mara 11%, NBIS is down 12%. And so, there's AMD, which beat and then raised guidance for next year, for the next quarter, although that didn't meet the wild expectations that people had or the whisper number. I mean, that's down 16.5%. And so I think today is pretty healthy. You have some profit taking and consolidation. One of the things to look out for in terms of market sentiment, and I was thinking about this the other day. I didn't tweet about it, which maybe I should have, but when people start coming up with new ideas, like, okay, this, like for example, I have an investment in Kraken, which provides, sonar aperture and also battery systems for underwater underwater unmanned vehicles. And so that's a pretty interesting company. I think it's great to own like a merchant supplier of the guts basically for all these UUVs, which are going to proliferate. But then, on Twitter, there was like some tweets over the past 2 weeks where it's like, hey, check this new stock out. This is the next Kraken. Or for AST too, it's like, hey, here's the next space stock. It's the next AST. Or T1 Energy. Here's the next one. The next thing that's, like T1 Energy. And when you have that type of euphoria to look for like the next best thing, and I'm not like poo-pooing any of those ideas, but that kind of gives you a sense of where the market is in terms of euphoria and perhaps being overextended sometimes. And so, similar to the bottom indicators that we talk about, sometimes there are these top indicators where if people are euphoric and every idea is working, then maybe it's time for the market to pull back. And so I think we're seeing some of that now. And so, today I talked about how I bought some AST, I bought some upside and some stock as well. And T1 Energy, I did the same, especially, down here I added. And, one other thing I wanted to talk about is the fact that, people are like, well, how do you have this endless amount of capital? I don't. I actually have limited capital, but I do trade around a small part of my portfolio. And so I think I mentioned before, like up to 5%. It's really even smaller than that. It's more like typically I may trade around 2-3%, if that. And that usually would be in a tax advantage account that I have, where the implications are not as punitive because obviously if you have capital gains, you've got to pay taxes on recognizing those, and the I will trade some of my cash position around as well, but typically for AST SpaceMob, for example, like I'm not touching well over 90% of that position because I have a very low cost basis. If anything, if I do sell, it will be in the tax advantage account, but more often than not, I'm just not trading that position. Now, from time to time, I'll trade options and I might trade some stock, maybe a few thousand shares here or there, which I've tweeted about. And sometimes people are like, well, you never sell. And I don't really advertise when I sell stuff. I mean, today, for example, I did tell people like, oh, I had this small position in Power Bank, and I actually ended up selling it because I wanted to consolidate it down into ASTI. And so I mentioned that. But I don't, I guess one thing I don't want is for people to think that I'm a really active trader and I'm just like whipping massive size around, which I'm not. I'm usually a buy and hold person, and from time to time, like I will monetize options, for example. And so I guess it was like a few weeks ago, I had an AST speculative option position which did quite well, and the proceeds from that was like a few $1,000,000, and so that's when I bought stock back in AST, because I was like, oh, I was able to increase the stock that I have in the company, and so I will have some trading positions. I'll talk about little speculative ones, but generally speaking, I don't really trade entire positions around. And so, but yeah, and I don't want people to think like I'm giving signals of this is what I'm going to sell and this is what I'm going to buy. And I typically, I it's kind of in a joking way, but I do, like when I tweet out like, oh, I bought the dip, I actually do buy those dips, but I just don't telegraph like when I might sell some things. And I don't know, maybe I should at some point, but more than anything, like I'm really just focused on fundamental research and just sharing news about ideas and my levels of conviction for those ideas. And so I try to stay away from like being one of these guys who give signals of when to buy and when to sell. But yeah, I will say for what it's worth, like, some of us, we talk about Reddit and the AST Space Mobile Reddit when it gets really negative, and when some of the long-standing bears get upvotes, then that's usually a pretty good bottom indicator, just like the kook bottom. And so I think those, from what I understand, I haven't looked at the Reddit today, but someone was telling me that it's flashing all the indicators. And so the sentiment there, I think, is pretty bad, which usually means like we're pretty close to a bottom, or tradable bottom, if that. So, but yeah, I think as I was saying before, today we're having a lot of big moves. I was just looking at the factor in Bloomberg, and value is up like 2%. Dividend yield stocks are up 1.8%. Companies that buy back shares 1.6%, and then momentum is down 4.5%. Growth is down 2.5%. 3-month EPS revision, so companies that keep revising up earnings, that's down 2.2%. And so, there's a lot of factor movements today, and I think it's pretty healthy. And for an individual investor, it's important. I keep pounding the table on this. Like, do not trade or invest in margin. Stay within your means. Just have a cash account. Like, don't. Obviously, sometimes it's good. I have a margin account, and you need that to facilitate stuff. Like if you're exiting something or you want to buy something ahead of time. But I don't really run margin, and quite candidly, I can't run margin because I permanently have my assets at E-Trade, and funny enough, like they give you no margin relief on companies like ASD, SpaceMob, or T1 Energy. So they actually keep me from doing bad things, even if I wanted to do bad things. And so that's good. I also have an account at a high touch broker, and they actually let me margin ASD, but I would never in a million years dream of doing that. Because the thing about margin, and I've talked about this, is that it can be a good tool if used very judiciously and at right moments, meaning, if you really think you have edge or you think there's a big price dislocation, then you might utilize margin, but you've got to be very disciplined about it. You got to have an entry point, exit point, or if it goes against you, you're going to close out. Last thing you want to do is be on margin for extended period of time, and then you eventually get tapped out, because using margin against high beta stocks is the quickest recipe for ruin, because things will go well, but then think about all the crypto traders who were leveraged along Bitcoin at 120, 100, and it just kept going down. Like they got fully liquidated and lost more than they probably expected. And so I think it's important to stay away from margin. And the reason why you do that is for days like today, where things are down and it sucks, but it's not as if you've got to meet some margin call, and hopefully you have some capital laying around and you're able to take advantage, right? Because for those hedge funds that are running really tight risk limits, they've got to de-risk, degross, and that's why you see these outsized moves. And volatility as an individual investor, where you're not reporting to LPs, where you don't have margin, you can be on the offense. You can take advantage of some of these dislocations, and obviously, in particular, names that you understand very well. You have a good fundamental point of view, and you believe, we joke about it, but if you like to stock at 100, you're going to love it at 90. And so as it moves down, for any investor, you hope for the ability to buy even lower, right? And so, and the other thing I would mention is in days like today, where let's say you had like, I'm just making numbers up, you had $100 in a low conviction name, you had $100 in a high conviction name, and both are down, or your high conviction name is down 20%, the low conviction name is down 25%. Well, you can use days like today to consolidate your position. You can sell the low conviction thing that's down 25, and then you buy more of the high conviction thing that's down 20. And so in that regard, you're upgrading the positions that you hold, right? And so that's also another way to take advantage of volatility. I'll be honest, like today, I'm very tempted. Like I have these Vodafone calls, these leaps, 2027, that are $15 and $17 calls that are up 3.5 and 3 times. And I'm very tempted to monetize some of those and deploy elsewhere. But then I still have conviction in that trade, so I'm going to continue to hold it. But I don't know. There might be a time, we're down today, but we could be down tomorrow and down the day after that. And there might be a time where, I break the glass and monetize some of those to deploy elsewhere. But yeah, I think in days like today, it's just a reminder that you celebrate the good days, but you also have to be prepared for the big drawdowns. And what's funny is I think some of these accounts that are on Twitter, maybe it's for engagement or whatever it is, but they'll celebrate that you're down, and they'll say, "I told you so." They'll do all these things to, I guess, try to make you feel bad, even though they're trying to make themselves feel good. But it's funny because like, I don't think any of the, and I'm talking about like AST in particular, or even this applies to T1 Energy, like for people who bought it too, or AST for people that your average is $5 or $6 or $7. These people are trying to, take the piss out of you. It's like, I don't care. Like yes, I think someone was saying, well, given, potentially the charts, if this continues, the stock could go to 70. Yeah, it could. If the world ends, all stocks could go to zero. I get it. But I have conviction in this, and I'm a long-term holder, and this is just a feature. This is part of, if AST was down 30 or 40%, while other stocks were down 10%, then yeah, there's certainly a problem because there's something company specific that's going on. But if the company is down 13%, the entire sector is down, let's see, anywhere between 11 and 18%, that's just beta. It has nothing to do with the company. It has everything to do with just risk off across the sector. And so I think it's important, especially for these people that are fixated on why is a company moving, in particular, without kind of, looking at that in a vacuum, without looking at the rest of the sector. The entire sector is down. It's just part of being invested in space. And so I think, as I mentioned before, I do think space overall is going to be and is a huge theme for this year. And so for those people who have been sitting on the sidelines or may have missed it, like here it is. Here's an entry point. Can things go lower? Sure. But if you're looking to invest, this is probably a good place to start. And I think it's important to understand what your time horizon is, because someone mentioned, don't invest money that you can't afford to lose. And that's true. And it's almost like real estate, like in New York or California, which is where I lived before as well. You have this thing where if you buy a home, and it doesn't matter any part of the cycle, if you buy a home, if you have a 1 or 2 year view, then you certainly could be buying the top. But if you are living in any of those markets for at least 5 years, any purchase, whether it's at the top or it's in the middle, or maybe it's even at the bottom, obviously in the bottom would be ideal. But if you have a 5-year view, you're going to be fine in New York or California real estate, because that typically is going to perform no matter what, even through various cycles, right? And so I think the same thing can be applied to stocks that could have good fundamental outlooks with significant opportunity. You might buy something at the top, and you might be down 10, 20, 30%, and that doesn't feel good. But if you're looking at things on a long-term basis, you're going to be fine. And I think I remember like so many conversations with people when AST was trading at 6 and it went to 7 and 8, and they're like, oh my God, I missed it. And, someone bought it at 12 and then it drew down to like 10, and they were angry with themselves. And now look back, I mean, it's like the company, today is moving more than the entire stock price was back then. And so I think it's good to have perspective, and just, put when you have days like this, sometimes the best thing to do, and you don't even have to do anything. Sometimes the best thing is just not do anything. But anyway, I'm going to see. Oh, the other point, and if anyone has questions or comments, feel free to leave them in the comments below. But the other thing is that when you do have these periods of drawdown, the stuff that is working, like kind of the marginal ideas, like oftentimes those will get hit pretty hard. And so it's important to remember, like if you have a portfolio and you have a bunch of marginal ideas and they're quick trades, you got to be careful, because like in periods of big drawdowns where you don't really know those names well and they're not high conviction, those can hurt you, right? Because then those are the ones that you'll have this drawdown and then you kick it out because you really don't understand the name, and then you feel bad afterwards, and that's capital that could have been used to apply to more higher conviction stuff. But like I said, that also, when you do have these drawdowns and the good and the bad names are going down, for any of those, it's almost like you can correct your mistakes, you can sell some of the lower conviction stuff and consolidate into higher conviction names. But anyway, let me see. I don't know if there's any comments here. But yeah, today I guess for what it's worth, like I bought some AST, some I bought a little early, but then I bought on the way down. I added some upside as well. I bought some T1 Energy. I bought a little bit of Bridger and some Strata Critical as well. These are all names that I've been following for quite some time. I also added a little bit of Velo, which is a very small speculative position, but that thing is so volatile that that's one name that I just like pretty much trade around. And I did add some Kraken as well today, which it's finally come back down a bit. But anyway, yeah, that's all I had to say pretty much. I'm gonna see if there's any questions or comments. Just look here. Here's a question. To tap into your institutional perspective, what constraints do funds face to load up on risk in these moments? Does retail have an edge in these moments? What constraints do they have? Well, if you're a hedge fund, I'm just talking about like a typical large multi-strategy fund that has pods. Pods will be a portfolio manager and maybe one or two analysts, or it could be a pretty big team. It could be like 10 people. The constraints are that can they load up risk in these moments? Well, I mean, the overall market indices aren't down that much, but then high beta names are down quite a bit. And so the constraints are that that fund that pod may be down 1 or 2% already. And so do they take a chance and by the way, they might be, maybe 80% deployed versus their risk limit. But do they, as a portfolio manager, is this going to last? Is there going to be more of a drawdown? And if so, do I buy now and then a further drawdown happens and I make things worse? Or do I de-risk today to live another day and see if things get worse tomorrow or the day after? And then maybe I can, deploy. And so it's pretty tough. I mean, because it's almost like damned if you do, damned if you don't type of thing, where these guys, they're probably down quite a bit. I mean, imagine like the big hedge fund names that everyone was in. I mean, there's probably a whole host of software names that hedge funds own, which they're getting absolutely clobbered on. And so, and yesterday, if they were long, part of the book software names, and they were short, which, I don't know how many institutions are short space stocks. I mean, clearly there's pretty decent short interest, but if they were short space stocks, they got completely reamed yesterday, right? And then say when space stocks are down, they're like, oh, great, the space stocks are down, so my shorts are working. And then they look at their software names, which are down again. And so they're in a bad place, right? And so when you're an institution, and this is on the hedge fund side, it's tough because you have to make good moves every single time, right? There's very limited room for mistakes. And if you have drawdown limits of, at some firms, they supposedly say, oh, you have a drawdown limit to 12% or 10%, which is pretty high. You might have an initial drawdown limit of 5%, and then they cut part of your capital, and then at 7% they cut, and then after maybe 10%, you're basically done. You're tapped out. And if you can imagine like your own portfolio, how much obviously you're not running a market neutral book, you're probably just long a bunch of high beta stuff. Being down 5 to 10% is pretty easy just in a day or two, right? And so imagine working under those constraints. Obviously, you're going to be short stuff, which usually will work for you, but sometimes you're on the wrong side. Your longs might be getting clobbered and the shorts might be going up in your face. And so that's why managing money on the hedge fund side can be really difficult, and it's very stressful. And so days like today where it's like, me, Joe Schmo, with a individual portfolio that's not on margin and has some cash lying around, I can go deploy, or if I want to, I can dial up risk. The way you might dial up risk is if you're in, I'll just make one, if you're in AST space bubble, you might sell some stock and then you buy some calls with that capital, right? And so that's one way to dial up risk. while you may not have any funds laying around, but you monetize some of your position to dial up risk. I'm not saying that's what you want to do, but that's one way to do it. Or, you might sell some low conviction names and buy higher conviction names, whatever it is, right? But for you as an individual investor, it's not like you have a risk manager looking over your shoulder and you got to worry about people on your team, like keeping their jobs, all these things. And so it's very stressful. It's not, I don't envy anyone in the industry, but if you're young and you're good at it, then it's great. And it's a great way to learn investing. And obviously people can and do make quite a bit of money. But it's also super stressful and you age very quickly. And so I don't miss that industry at all. I'm having more fun doing this and hanging out with all you guys. But yeah, in moments like this, there are times, by the way, like if you have a huge market crash and if the CIO of the firm and the chief risk officer is managing that firm properly, they may go out to PMs and say, hey, whether it was like the US getting downgraded, the credit rating, this is like back in 2012, the tariff announcements, which for the astute hedge funds, they were like, okay, this is the time to go on the offense, right? Like this is an overreaction by the market. They may come back, you might get an order from up high to say, hey, deploy risk now, because we think this is a good opportunity to take advantage of dislocation. But yeah, it's tough. It's not easy. And in a time like this, as a hedge fund manager, a portfolio manager, you've got to weigh your decisions. Like, do you go on the offense now, or is it too early? If you're down already a few percent and you're getting close to your risk limits, do you take that risk and deploy now, or do you cut risk and live to fight another day? And so, when people get their capital cut, that's pretty bad. Because if you imagine, let's say you're running a book that's, I don't know, $500 million, and then you're down 3 or 4%. And then, you're pretty close to your risk limit of getting your capital cut. So let's just say you're down 5%. So you're down $25 million. And if you go another 2%, let's say you get your capital cut in half, right? So let's see. So if you were down, let's say you're down $37.5 million, you get your capital cut to 250. So it's hard to dig out of that hole. Like if you're down $37.5 million and you're only working with 250 million of capital, then that watermark is really hard to get over. And so that's why it's almost like the hundreds of teams that a Millennium or a Citadel will go through, only very few will have longevity. And those are, you almost have to be a psychopath to make it through. And that's, by the way, like these large multi-strategy firms, not everybody operates this way. And of course you have hedge funds that are not multi-strategy. And they might be more like a small family, more operating like a family office or something. But yeah, that's why you see exaggerated moves in stocks sometimes when risk overall is getting degrossed. Degross means if a hedge fund is running at 2-3 times leverage and things are not working for them, they might tell the people who make investing decisions it's time to degross. Degross meaning we're going to go from 3 times leverage. So if you had $500 million like of AUM that you're managing, and the fund is deploying 1.5 billion of long and shorts, that's 3 times leverage. They're like, hey, we're going to degross because things are not going well, and I want you to degross by 1 turn. So we're going to go from 1.5 billion to 1 billion of deployed capital. That means you're covering your shorts and you're selling your longs, right? And so that means liquidity in general is coming out of the market, and that's why some days where things are pretty bad, you'll see heavily short names up on that day, and of course popular names down, because oftentimes that's hedge funds that are covering their shorts and they're selling their longs. And so, for example, in the financial crisis, there were many days like that where it's clear some hedge funds were degrossing, or sometimes it's just one hedge fund. Like you'll see one you'll see moves exaggerated in a handful of names, and it's because, oh yeah, that fund is degrossing or they're in big trouble. And I remember in 2008, that's like when that was the soup du jour. That was the soup of the day, where people would look at holdings of various hedge funds and go attack them, right? Like if you knew that some hedge fund was not doing well, you might go see what their longs were, and of course, you heard like them pitching their shorts, and then people would try to induce more pain and profit from that, which is kind of crazy. But that's I mean, on the flip side of that, you also from a risk management point of view, you would do that to save your own ass, because it's like, okay, do we have overlap with that guy? And if we do, we need to get ahead of their selling, because if that place is shutting down or they're in trouble, I don't want to hold the same things they're holding. And so people went through that that analysis. But let me see. There's any other comments here. On these larger drawdowns, does it make sense to move some shares into leaps for a little extra juice? Yeah, it can. You could certainly do that. But of course, like, you've got to have a point of view. Like, you have high conviction, you think this is the right level to do it. And so you might do a little of that. And by the way, like, it's not a binary thing. It's not like, I'm going to sell my entire position and put it all into this. You can do something small, like and sometimes it's good on days like this where it's like, well, I don't have conviction to do anything, which is fine too. Or to make myself feel better, I might do 1 or 2% or 3% of my position, just to feel like I've done something and mentally have this check mark that on that day I did something and it was good. Or it could end up being bad. But I think on larger drawdowns, what this person's saying, sell some shares and own leaps for a little extra juice. Yeah, you could do that. But just know that, you're increasing your risk. And then, of course, for leaps, depending on if they're in the money or out of the money, it's a different trade than obviously owning stock. Let's see, Francisco didn't add Rocket Lab. No, I did not add Rocket Lab, although it is tempting, but I'll let you know if I do. By the way, I haven't really held Rocket Lab. I've owned it from time to time, but for me, I have the highest conviction in AST SpaceMob. It's not a knock on Rocket Lab, but I think these stocks have such high correlation in relationship to one another. If you own one, it's almost like you own the other, and so increasing exposure to, allocating risk to Rocket Lab. For me, it's just like, well, I kind of own the space sector now. So I tend to not really own it, but I will trade from time to time. Let's see. What's your current view on IREN, which is heavily down today? I don't really have a view on the data center names. Honestly, I'm not going to speak to it because I don't, I haven't followed them. And for me to tell you anything would be bad because I'm just not educated on those things. But yeah, I mean, they're all down. They're all down quite heavily. But it's no different than the other tech sectors. I mean, you can pick almost any ticker. It's like Palantir down 13.4%, Robinhood down 10%, AMD down 17%. I mean, you pick any ticker and it's down. Let's see, yeah, I guess some of these software names have bottomed a little bit, but yeah, I don't have a view. There is Jim Chanos who obviously is a bear on the sector, and I guess he's trying to add more misery by saying, well, if these space companies are able to build data centers in space, then the terminal value of these data center companies is zero, which is absurd. Doesn't make any sense, and we're so far away from that becoming a reality. Although I think it's going to happen, but if you look at these projections of how much compute power AI applications need, then I think there will be demand for all these data centers here on Earth and in space. And obviously, it's not going to be a straight line, and there's going to be bumps along the way. Maybe an overbuild. I mean, I think the biggest concern that people have is similar to the .com bubble, where people were overbuilding optical networks and fiber and all this other stuff because the demand for carrying data was up and to the right, and it was never ending. And then, of course, the bubble burst, and all those companies got completely demolished. I think it's and famous last words. I think it's different this time, in the sense that back then the businesses that were raising money and they were very questionable ideas during the .com boom, whether it's selling pet food online or whatever it is, right? Whereas I think we all see the real practical use of AI today. And so I think it is quite different, but yeah, you're probably going to have periods of overbuild or demand that is overly optimistic, and so there's going to be some pullbacks, and I think that's quite natural. But yeah, sorry, I don't have a strong view on Iran. Let's see. What's your read on the market? Are we getting into a bearish trend? This fall today is so crazy. What's your new bottom for ASTS? My average is 70. I don't know. I'm quite bullish on the space sector. I'm not following some of the other sectors as closely. Can we continue to fall? Sure, we could continue to fall. Could we get to 50? I don't think so. I think given all the catalysts that are lined up and the interest around space and of course the SpaceX IPO, but then the real beat, which is launch of commercial service and military awards. I think we are pretty. I think 100 is kind of the support level of the company. Obviously, we're trading just under that, which it's like anything in and around 100 is good to me. I remember back in the day when we were all celebrating that 20 was like the new support level, which was back in the first part of 2025. That we consolidated there for a really long time. I think right now we're kind of doing that until some of these other things kick in. But yeah, are we in a bearish trend? I don't think we are for the markets. I think there definitely is movement around where people want exposure or not. I mean, for example, software, obviously there's a lot of unknowns there, and so people are selling first and figuring it out later. There's credit. Credit is like a very hot topic, and I for better or for worse, I own Pagaya, which has exposure to the credit markets, and there's a lot of concerns there around consumer credit, and so that stock has taken a pretty big hit. But I own warrants, and so I'm pretty much set and forget on those. I'm still up quite a bit on those, but unless things change, the company has continued to execute even in the face of all these concerns, and so yeah, we'll see. But I don't have a negative view of the market. I think these pullbacks are healthy, and we have, obviously, I guess I'll just say a small thing. We have a new Fed chair that's potentially coming in, and people have this view that this guy has said hawkish stuff before, and he's perhaps going to be really bad for the market. It's possible. I mean, anything's possible, but I think Donald Trump, and I'm not trying to be political or anything, but I think for him to have picked this chair, that this new Fed chair probably has to have the same point of view in terms of bringing rates down and being somewhat accommodative, even though historically that's not been the case. And I think some of the folks who have pushed back and said, well, look at Powell. When he came in, we thought that he would be friendly to Trump, and then he ended up being balanced, which is good. Like, he was an independent, and I think obviously that was in the first Trump administration. I think this time around they've learned some lessons, and so for him to have nominated the current Fed chair nominee, I would assume that guy has pretty much said, like, hey, I'm going to be loyal. When you say jump, I'll say how high. And so I don't think this guy's going to be hawkish in any way, shape, or form. Because I think if you look at, for example, some of the politicians like Mark Rubio, he went from being completely anti-Trump to being 100% on board with this administration. So I don't think we're heading to a period of a hawkish Fed. And if you look at some of these alternative measures for inflation, it looks like inflation still continuing to come down. The only concern I have is commodities, where obviously there's a ton of speculation in silver and gold and some of these other metals. But just like crypto and you're seeing quite a bit of speculation taken out of those areas. So yeah, I'm actually pretty constructive on markets, and we're gonna continue to have some of this groping around for direction, but I think it's pretty natural. And like I said, as a retail investor, volatility is your friend. It allows you to get good entries. It also allows you, if you're a trader or if you're looking to trim things, it allows you good exits too. And so that's a good thing. Does macro impact when a company may announce news, or do they typically not care? Macro usually does not. Now, that said, companies are aware, and so if it's a really bad time, they might save some news for a better time. But in general, I think most companies, and of course there are kind of some constraints. Like if there's material news, then they have to release that within a certain period of time, and so it may not be up to them. But generally speaking, I think most companies will release news as it comes. And so, but if there's some really bad days, then perhaps they might hold off. In a tax advantage account, does low cost basis matter more than total share count, considering how IRAs are structured? In a tax advantage account, your cost basis doesn't really matter. It matter in a sense of, picking lots to trade or things like that. Because what matters is how much money you put into the account, your contributions, and then how much at the end, when you retire, how much are you taking out, and then Uncle Sam gets their share. So it doesn't really matter. But for non-tax advantage accounts like cash accounts, if you are someone who trades stuff around, you need to keep very good tabs on your cost basis and how your brokerage, whether it does it automatically, but ideally you want to have control over what selecting tax lots, right? And so I'll give you an example. Like if you have owned AST SpaceMob for many years and your cost basis is 5, and then let's say you trade a few shares, you buy a few recently, let's say you buy some today at 98, and then maybe a few days from now, you're like, okay, I want to sell some shares just to monetize some of the gains. You absolutely need to go into your brokerage app and select the shares that you bought for 98, because then if you sell it at 110 or 120, you're going to pay short-term tax, but then short-term capital gains, but it's going to be on a small amount. It's going to be for the difference between 120 and 98. So that's like $22. You want to do that versus paying long-term capital gains on, if your cost basis was 6 and you're selling at 120, that's a really big capital gain. And even your long-term capital gain treatment of that, you're still going to pay a pretty hefty chunk, which then, that's money that comes out of your investment account that you have to pay to Uncle Sam. And so it's important to manage your tax lots. I'm sure most of you guys know this, or hopefully you do. If you haven't or you don't know, be sure to look up information on managing your tax lots. Also understand what your brokerage, what system they use. Because oftentimes you can pick like last in, first out, or optimal. There's a setting like automatic for maximizing tax efficiency, like E-Trade has that, for example. But that's something that you should certainly pay attention to. And there are times when it might make sense to sell long-term capital gains on stock, because maybe you have a long-term capital loss that you recognize in the year. And so there's a lot of intricacies in managing that. So anyway, I'm going to stop there. I just wanted to check in with people. Here's another question. What's your take on the delay of shipping the next batch? So I've talked about this quite a bit. There is a backup down at Cape Canaveral. And so you have Artemis that's going on, and then the Crude Dragon Falcon 9 launch that's happening as well. And so, and I believe there's like some construction going on. So the amount of launch pads and processing facilities that are owned by SpaceX are limited, because they're doing some of their own stuff. And obviously we just had this, SpaceX had this anomaly with one of their Falcon 9 rockets. And so they have to investigate that a bit. So this is just part of owning a space company. We will not ship a batch down there until they're ready to receive and process it. And so, yeah, it's we're just waiting for that. I mean, obviously the near term launch is going to be Blue Origin, New Glenn 3, and FM2, which will be towards no earlier than the end of this month. And then I assume it's just my base case that I think we'll probably get 1 to 2 additional launches before March 31st. But so that's 4 in total. But there is a chance, like maybe it slips and you get 3, and then 2 come pretty quickly after that. And so, yeah, I think that's kind of where we are. It is what it is in terms of the traffic that's down there at Cape Canaveral. And the thing is like, you don't want to, throw your launch providers under the bus and say, hey, we're ready to ship this batch, and then, but we're going to wait because they can't process it. You want to be on the good side of whoever you're using, whether that's SpaceX or Blue Origin or Israel for now. But that is it. I'm going to end the space today. I've got I had like a number of things going on, and of course our daughter is she has a fever today, unfortunately, but she's feeling better, so I need to go check in on her. But yeah, thanks for joining, everyone, and yeah, just be calm. Like, this is just normal stuff, that normal noise in the market, to me, that is, and so I think it's important to remember that a lot of the stocks that I assume you're involved in, since you're listening to this, are up pretty significantly for the year. And so having these drawdowns happens, and it's just a part of the process. So anyway, thanks everyone for joining, and we'll talk again soon.
Thanks for listening to the AST SpaceMob podcast. If you enjoyed this episode and you'd like to help support the podcast, please share it with others, post about it on social media, or leave a rating and review. To catch all the latest news about AST SpaceMob, make sure to subscribe. Thanks again, and I'll see you next time.
We're doing something very, very big. And I think with this technology, we can really affect billion lives. AST SpaceMob is the only company that has proven technology to deliver cellular broadband connectivity directly from space to your everyday smartphone. People will just basically turn their phone and be seamless, regardless of where you are. We don't want the user even to know that it's connected by satellite. Our role is to bring this into reality, always in partnership with the MNOs. Listen.